Recording in progress. Okay, so am I in the back room now? I guess it's recording.
Oh, it's recording. So you can press recording.
Great. Well, welcome everyone. We'll just go ahead and get started, and we definitely expect a lot more people to come as we get going here. But I know that everyone is super psyched. I'm psyched to talk with Andrew. How do you pronounce your last name? Gazdecki?
Great. Yeah, Gazdecki. Usually when I'm on podcasts, I literally, before we start recording, they're the last. How do you pronounce it? And I'm like, you got to guess live. So you did good, Gazdecki.
And who almost in some sense needs no introduction himself. Many of you follow him on Twitter. He runs Acquire. And so we're going to talk about acquisitions today. And this is a fairly free-flowing session, as many of you have been to some of these before, where if you have questions for Andrew, go ahead and type them either in the chat or the Q&A feature. I'll pull from them and ask him your questions. But I find that typically people are pretty shy right out of the gate. So I have a lot of questions as well, and we'll go ahead and get started. So Andrew, welcome. Thank you for joining.
Yeah, thanks for having me.
And let me ask you a little bit about your background, because I know it's so important to the Acquire story. Tell us a little bit about what you were doing before and how did you end up building Acquire?
Yeah, good question. Been entrepreneur kind of my whole life. I was that odd kid selling baseball cards when everyone was collecting them. Had like a eBay store when I was 13. I always say, like, some kids when they're growing up, they say they want to be the quarterback of like a football team or something like that. And I was like, I want to be the CEO of a company for some reason. So I just always loved business. And so I started a business in college. My first like real business was this job board that connected mobile developers with businesses. And it was super simple. Ended up selling it for what felt like $1 trillion billion in college, but it was like 40K or something like that. But like enough to, that was a memory I'll never forget. But the reason I sold it was I saw people making a similar job request for a mobile app to be developed for the high-end restaurant, hotels. So I used that as seed capital to start like a no-code mobile app builder. It was called Bizness Apps, really creative name. And the idea was, when you cold call, like, hey, this is Bizness Apps, so they immediately understand it. Exited that business when I was 29 to a private equity firm. After that, started a crypto company for some reason. We were trying to speed up times on the Ethereum blockchain, so it doesn't take so long. It's still slow, so we obviously didn't succeed. But we sold that company to B&K the Future, which is like WeFund or Republic for crypto projects.
Mm-hmm.
And then, yeah, after that, I didn't have any startup ideas. I was super bored. I became a top 100 Madden player.
Wow.
You got to play a lot to do that. And my wife was like, you got to do, like, what are you doing? And so, started, Acquire now, really as a side project. I just thought a way to, I originally thought maybe I could buy a business, maybe there's something here. And it just kind of grew from there. But I thought, there was going to be a growing trend with people looking to enter entrepreneurship through acquisition. And I kept reading about people creating, let's call them, small private equity portfolios. I thought that was really fascinating. So I kind of started it just to learn and see where it takes me, just like I did with the job board. I knew mobile was going to be big, so I just wanted to get in the game and see where that took me. And then with Microacquire, now Acquire, which is still odd for me to say. Rebrands are confusing after years, but yeah, that's the short version of kind of my life story.
Yeah. Yeah, I love that story. I think you know, obviously when you talk about founder market fit, you have such great founder market fit for, you know, for the idea that you're working on. I think switching gears slightly, because acquisitions are, you know, such a black box for many people. What is sort of even just the high level process of going through an acquisition? How does one get acquired?
Yeah, from a very high level, I have some like presentations and like decks I can share and like run. There's really like two tracks that I think of in terms of acquisitions. One is, you know, I'm sure everyone's heard, you know, companies are bought, not sold. That's not true.
It
Maybe
is
if you're,
not true.
well, maybe if you're like Slack and you're growing like crazy and, you know, Salesforce approaches you, but I think a lot of entrepreneurs, including myself, you know, I think Google just shows up with a check and just says, hey, you're
That does
acquired.
not happen. Yeah, I
No,
hear
you,
you.
you got to sell your business. Like you got to, so unless you're, you know, being chased down by strategic buyers and you're growing so fast that every month they wait, you're going to be valued more. Most startups aren't in that bucket, and that's okay. So generally a process is what you want to run. So you want to sell your business. That involves a lot of preparation, you know, creating a data room. There's some other documents like a SIM, which is just a fancy word, confidential information memorandum. It's like a big book about your business, lots of questions, gives buyers like a good overview of how does it work inside and out, due diligence checklist, clean financials. And then what you do from there is you go out and market your business. So you reach out to buyers, speak with buyers, have conversations. And then from there, based on interest level, just like raising venture capital, you know, you want to at some point propose a deal schedule where you put everyone on a timeline. So you prep the business, everything's ready to go. And then you meet with a number of different buyers. I always recommend first call you, am I going too granular or like, should I?
No, keep going.
All
I
right.
think this is great for people to hear, because I personally think it's very similar to the fundraising process, but most people have no idea what it even looks like.
It really is. Yeah. So a lot of similarities. And so, you know, on the first call with the buyer, you know, my recommendation is, you know, talk very high level about the business. It's usually not the best time to go really, you know, specific into metrics, this, that, you know, because I've never really seen an acquisition go through without some goodwill. And so that's what I mean, even with investors, you know, just get to know them. It's, it really is, you know, kind of a relationship-based transaction, because you're not just handing over the keys to a car and being like, good luck. You know, you're going to have a transition period. If you sell to a strategic, you're typically going to have the earnout for many years. If it's an all cash transaction, which I personally had, you still have a period of time that you got to work with the buyer. And if, you know, if that goodwill isn't there, the buyers, it's a great way to scare buyers away. If you're difficult to work with, or you're really defensive about simple questions, which you can't, I was as a founder, you know, why is this way? And you're like, oh, like, it's such a good idea. And they're like, well, we do it this way, you know, just little things like that can tear your deal apart. But anyway, so first call, you're just getting to know buyers, you're letting them get to know you. You're open and flexible, you're easy to work with. You're really trying to figure out who is a person that, or group or firm or whatever you want to call it, company is the best fit to acquire a company. And then based off that, you go through a number of different calls, pre-due diligence, you know, going through everything that you presented. And the point of due diligence is really just to prove what you've stated is factually accurate, from your financials to reviewing your code, understanding your team composition, your go-to-market, how do you acquire customers, how do you keep them, how does customer support work, kind of the full 360 view of your business. And then the deal schedule. You care if I flash one really quick, if that's helpful?
Sure. And while you're pulling that up, I'm going to think just sort of at a high level, digesting what you just said, like I kind of alluded to, I personally think the acquisition process is very similar to the fundraising process in that most companies don't have investors who are approaching them. Similarly, most people are not approaching you about getting acquired. You have to run your process. You have to run your process well. You have to run a tight process on a timeline. And at the same time, to this point though, about companies are bought, not sold, like I think you obviously don't want to be desperate. And by running a tight process, that kind of helps you have some leverage. But continue. I see this slide now.
Yeah, so this would be just a very basic example of a deal schedule and a stage gate process. So, you let all buyers know, like, hey, you only have until this date to schedule a call with me. Around this date is when we expect an indicative offer, which could be a IOI or a verbal offer, just some sort of indication that they're interested in moving towards a formal offer, which would be a letter of intent. And then that's when, similar to raising venture capital, if you run this properly, the benefit of doing this is you keep everyone on the same schedule. LOIs come in at the same time, because when you're selling your business, if you have one LOI come in from a great buyer, let's say it happens on today, and then you go out and start talking to other buyers and nothing materializes, and then you go back to the original buyer 30 days later, they're going to know that you have no other buyers and they have a lot of leverage.
No leverage.
Yeah, yeah. There's a saying, if you have one buyer, you have no buyers. So this way you control the timeline in terms, and just like raising venture capital, you typically want all your term sheets to come in around the same time because they have expiration dates on them. LOIs do as well. Depending on the firm, it could be a day, it could be a week, it could be a month. It varies. And so by having them all come in at the same time, you have leverage where you can negotiate, not just on price, but also on terms. I always say terms are, just as important as, the final purchase price, because there's a big difference between, 3 million, or let's call it 10 million in stock or 10 million in cash, big difference. Or even, offers where it's total purchase price 10 million, 8 of it is stock and 2 of it's cash, compared to 7 million is all cash and you get to walk away in 30 days, something like that. So when you have multiple offers coming in at the same time, if there's any sort of earnout component, conditional holdback, any term that you don't agree with, you have leverage to negotiate against other buyers. So that's from a very, very high level. I could keep rambling and ranting on this.
Well,
that's generally.
I want to hold that thought, because we'll certainly talk about all the different components about earnouts and stock versus cash and all that, because that's big and hairy. But I think I want to even let's pull us out of the weeds a tinge and talk about, like, how does one even approach this process? When you're running a fundraising process, there are directories out there of VCs and stuff, and so you can kind of know who to approach. Who do you approach here to even bring into your process?
Yeah, I mean, everyone knows their competitors, and that's generally the best place to start, depending on your comfort level. And I think the first question you really need to clear is, are you selling the business, or are you kind of just dipping your toes in the water? Because those are also two different strategies. One is more long-term. One is, hey, I'm selling the business, I'm going to let everybody know, and we're going to run a process. That's more or less of what I just explained a second ago. If you're looking to just kind of, build interest, having those first initial calls with strategic acquirers, usually ones that would be also great partnership fits. Those are good to bring into, your potential acquirer pipeline. But I always recommend, mapping out who could potentially acquire your company from day one, and trying to foster those relationships. And usually it would be at a larger company, it'd be usually the head of corporate development, head of partnerships. The head of corporate development, depending on the company, typically works really tightly with the chief product officer. So they're typically in a build versus buy versus situation. So being friendly with both those individuals can be advantageous to you. But also private equity groups. Private equity groups are literally companies that just buy other technology companies. So by reaching out to them as well, and just starting that conversation either now or later, just creating that sort of relationship early, just makes it so much easier when you do actually run a process if you choose to go down that route.
Mm-hmm.
Like, and I'll give one more personal anecdote. So when I sold Bizness Apps, I would update potential buyers kind of like maybe once a quarter. Nothing, like, hey, just like, hey, Greg at web.com. Here's 5 bullet points on what we've been doing. Hope you've been well. How's golf? Because you like golf. And just you keeping them updated, keeps you top of mind. And then eventually when we were ready to sell, everyone that I had personally reached out to was familiar with my business. That really speeds a lot of the, who are you? Is this an opportunity? Are you like, what is your business? So doing that in advance, I highly recommend.
Mm-hmm. And drawing similarities to the fundraise process, like obviously all of these things take time and there's sort of trade-offs there, but the more that you can build relationships ahead of any transaction, the easier it is because they already know who you are. I like that a lot. Let's go into one of the questions that we have here. Dave asks, early stage acquisitions could be about IP, could be about hiring like an acqui-hire, could be about the revenue run rate. He has a question specifically about micro-acquire, like which of these angles kind of do best. But I think more generally speaking, how do you think about positioning a company based on some of these assets? Because as an early stage company, if you're selling at that early stage, you don't have a whole lot of any of these. So how do you kind of advise companies to position themselves?
Yeah, that's a great question. So traditionally early acquisitions for IP hiring or run rate revenue, it's actually, kind of true for all stages of acquisitions in some form. But yeah, in the early stages, it could be an acqui-hire, it could be you've built a killer product and, a larger company has a customer base that would easily purchase that product from them. So they already have distribution in place. But yeah, in the early stages, you want to think about use cases or business cases. Is there an adjacent sort of market opportunity that you can help accelerate a large business getting into, as an example? That's a great, conversation to have with potential strategic acquirers. And then in terms of the startups that I see acquired are generally on the profitable side. So typically SaaS, profitable, and like it's like a feeding frenzy. It's kind of interesting to watch. But
do you see like you have to kind of get over a certain threshold before your business is interesting enough?
it depends on to who. So from my vantage point and what I've seen strategic companies. So I should clarify, there's financial buyers and there's strategic buyers. So strategic buyers are companies, Google, Apple, Facebook. And then financial buyers are private equity firms, et cetera. And so, I've seen strategic buyers come in and purchase really small products. Recently, we've been seeing a big rush in terms of just acqui-hiring teams working on AI products, which is really interesting. So that's the business case. They need an AI play. They need to hire people. So they just kind of acquire a product and a team all at once. And then so in terms of like the thresholds for that, really, there isn't like a low bar that I've seen or a high bar. It's kind of very company agnostic, I guess. But typically strategics will like to lean in when there is some form of scale in the business and some form of, repeatability. the less problems they have to personally fix when they acquire the business, the better, makes it more attractive. And that's also same with financial buyers as well. That's why financial buyers will typically look at, net profit being, the number one metric when acquiring the business.
So if you had to put a stake in it, what do you think that is? Like $1 million revenue run rate for a SaaS company, or
I would say,
higher?
Yeah, once you get above, $1 million, I'd say in profit, that's when
Uh-huh.
you have a business that will sell fast, very fast, because you've built a business that is capital efficient, and this is especially relevant today. But there's also scenarios where you may be at $1 million but break even because you're reinvesting everything into growth, and
Mhm.
you're starting to grow pretty quickly, and that return on capital is healthy. You're putting $1 in, you're getting 5 out. That makes a lot of sense. Doesn't make sense to pull back on growth at that stage. But I would say, we see businesses that sell even with $250,000 of revenue or even no revenue. But the larger the business and the more profitable the business, the faster, we'll see it sell and the more buyer interest we'll see. But
Mhm.
there's just so many variables. Like, I don't want to give like you must be in this exact box to get acquired, because
Sure.
I've seen
Yep.
companies losing money. I've seen companies raise a bunch of money and have no revenue get acquired. I've seen there is no I guess perfect answer there, but aside from the best businesses to acquire, the best are the ones you don't want to sell because they're either growing, super profitable. So I would just say focus on building a great business and you'll be fine.
Yep. And again, that has parallels to fundraising where there isn't a hard and fast rule, though I think it is helpful to some extent. So that way people have a general sense of what range you're kind of talking about in terms of probability of like, should I even be spending my time on this if I am making 50K a year? It sounds like that's a much harder sell than, making 5 million a year. So I guess like switching gears slightly here, let's say that a company is more interesting to an acquirer for the team, so more like an acqui-hire situation. How does compensation typically work in that case, with vesting or handcuffs, as they like to call it, or what gets offered, stuff like that?
Yeah, good question. It really depends. But typical format would be, you get a job. You get a job with usually a very generous stock option package that will vest over 4 years. The company that you've created is usually dissolved, or it's a stock purchase, so they'll buy the whole company, but usually they'll just dissolve it and it's an asset purchase. And then part of that purchase agreement is a agreement to bring you on to their company, their team, with, again, a generous salary, comp package, and your IP is rolled into the larger company.
And do you have a sense of, what typical vesting periods you're seeing? Is it 4 years? Is it longer, shorter? I'm sure it varies, but
It depends, but typically 4 years is the, I'd say the most common, but that's a leverage and negotiation piece as well, depending on, how attractive your business is. But going back to, the amount of buyer interest, and this is why it's so important to create a lot of buyer interest all at once, because if 4 years is too long for you, it would be for me. I just couldn't do it. You can negotiate against that. You can say, hey, I'd love to come in. Can we do the vesting schedule down to 2 years? Because I have another offer from a financial buyer who's saying all cash. I want to, help. I believe in your company's mission, et cetera, et cetera. but 4 years is a lot. Can we get to 2? And I'm sure you've also seen that with venture capital too, where, when you raise venture capital, typically, a founder's stock in the company will revest. And so that's another negotiation point, depending on how much leverage you have in that. But typically I'd anticipate, around, 3-4 years. I've seen 5 and 6 though, so I don't know.
So what, I guess, when people think acquisitions, they typically think, oh my gosh, I'm going to make all this money. The reality is a lot of acquisitions are not that lucrative. Can you kind of break down, like, in your typical acquisition, what ends up happening mechanics wise of, all right, let's say an acquirer says, hey, we're going to put you all on these employment packages with golden handcuffs. And then there's some consideration, however you want to divide up amongst your investors or anybody else. What happens? Like, what do the founders get to decide that? Does that get decided based on the cap table? Like, how have you typically seen this structure?
Yeah, again, it depends. And most of the acquisitions that we see are typically not venture backed, so they're bootstrap businesses. So the cap table's clean. Founder receives 100% of, not usually, usually like 90%, because some will be, distributed amongst the team. And in those acquisitions, those can be, very life changing. But let's say you've raised, $10 million and you sell for, let's say you've raised $10 million at a 30 million valuation. You got two, I'm already losing the math here. Okay, let's just say you have no co-founders, but okay, you raised $10 million at a $30 million valuation, and you end up selling at, I don't know, let's just leave it at 30 million to keep it simple in my head. So you own 2/3 of the business. And then when you sell, there's something called a liquidation preference. So that 10 million immediately goes back to investors. And so whatever is left over is then divided amongst investors. So you may see 30 million as kind of, the sale price, but the take home for the founders, this would actually be a pretty good acquisition for founder. Now that I'm thinking about it. And Elizabeth, help me with the math if I'm getting this wrong. But so, out of the 30 million, I have 20 million. And as the single founder, you have a third of that. So that's 66%. So you would then walk with 12 million-ish. Did I do that math right? 13 or something like that?
Oh, why don't you walk away with the full remaining 2/3, the 20 million?
Because you only own 66% equity. So dilute, so 1x liquidation preference. So 30 million, 10 million goes back to investors.
Right. And
then we're left with 20 million of the acquisition. And out of that, you own 66% of that. And so that would be 12, 13.
Oh, I see. If you have the liquidation preference of investors being paid back first and then whatever's left dividing amongst the cap table.
Yes.
Yeah, I see. Yes, that is certainly one scenario. So 66% of 20, which is 12-ish, 13.
And that's great. And yeah, that's not bad. But yeah, it can get more complex where you have, let's say you have multiple co-founders, and then you have more capital raised, and then, it can get very, very, what's the word I'm looking for? Let's say it's all on stock, none of it's on cash. So at close, you actually don't walk away with really too much. You have to earn that stock back, and it could even be private stock. So some scenarios can even be, you sell a business, 50% cash, 50% stock. Everything's equally divided amongst investors. Everyone's made whole. But then another, scenario you could unfortunately run into is if that stock is private and is never liquidated through an acquisition or an IPO, well, you never get paid for that. So you only got 50% cash. I hope that answers your question. I see less of that and more on the clean cap table side, but those are scenarios that happen.
Sure. Switching gears a bit, there are a number of questions about, people cold emailing you, like it would be acquirers, M&A firms or brokers or whatever, cold emailing you about potentially acquiring you, whether it's now or down the road, and who knows if these people are serious or whatever. Should you take those meetings? Like, if you're not entirely sure whether you want to sell, should you take a meeting? Like, how do you think about playing this if you're not in the actual process itself?
It depends. I mean, every private equity firm on the planet has some cold email thing going on. So I used to get them all the time, just respond back with like a question that would be hard to answer about your business. And you'll find out very quickly if you're just getting the same email as 1,000 other companies on that same day at that same time. But I mean, that's kind of what private equity firms do for deal flow. They just spray and pray, which isn't bad. I mean, if it's a good firm, if Vista Equity or Thomas Bravo reaches out, I mean, that's maybe a call to take. But yeah, like if Google reaches out or something like that, like that's a call to take. I think it just depends in context of where you are and who it's from. So if it's a company or a firm that you've heard of, or there's some, credibility behind that. But the ones that I recommend avoiding are, we can help you sell your business or something like that. You're probably just in a giant database. It can't hurt to take the call just to hear what they have to say. But again, just depending on where you are, I'm a big fan of just saying no to basically everything.
And how do you know how much information is too much to share when you're not in that process? Like, what if information could be used against you because they're actually scoping things out for a competitor or whatever it is? How do you think about sharing information? How deeply do you go into this if you're not actually in a process?
I mean, I'd always recommend, again, first call is just goodwill. Like, who are you? What's your favorite color? It can go a long ways, and you can really feel people out in terms of their intentions. And then if you do start to get into, sensitive conversations around how your product works, you definitely don't want to give away your secret sauce if you have it. You probably don't, in my view. And if you do, you could probably figure it out if you wanted to. But I mean, I'd recommend, getting an NDA in place. If the meeting's, serious enough, meet in person, go fly to them or have them fly to you, get coffee, and continue that, rapport building. But depending on the level of questions, I think kind of, red flags out of the gate is just, if they email you just like 20 questions that are very specific about your business and how it operates, I would avoid that strongly. Unless you've built that goodwill and you're in a process and it's kind of like feeling like pre-due diligence, like they've expressed interest in moving towards, formal offer, and they have these sets of questions. That's very typical. But if you're unsure, I mean, meeting the person, having just, multiple calls just to meet other stakeholders in their business aside from just them, I think that's a very appropriate ask. Like, is there any way we can just bring in another person on your team just to figure out who's involved in this, what's going on behind the scenes, what is your intention for reaching out? And then just figuring out if, can you foresee yourself, working with these individuals?
Mm-hmm. And I mean, I guess like on the flip side, the buyer side of things, I guess first off, lots of questions about what kinds of buyers you have on your site, on Acquire. And then also, I guess the other thing is there a way that you can, I don't know, ensure that maybe an NDA takes care of it or not, but like ensure that sensitive information either shared through your acquire site or elsewhere, like is actually only going to stay with the buyer and not kind of get out.
Yeah, good question. So types of buyers, we see kind of all types. So, there's entrepreneurs looking to buy companies, typically on the lower side. And then there's, small private equity firms that are typically looking to buy, it's called sub 10 million assets, or businesses. And then we also work with, family offices, larger private equity firms, public companies, other VC-backed businesses, roll-up plays. We have a number of different just buyer groups, all interested in different types of businesses for different reasons. So pretty much kind of the whole gamut from, individual to strategic to financial. The majority of buyers on acquire.com are financial buyers. So lots of private equity firms, high interest in, again, profitability, sustainable businesses. And then in terms of, how Acquire operates, just from a high level. So when you list on Acquire, everything is completely private. And the only private data that you share with buyers is entirely up to you. And that's only after a signed NDA that's built into the marketplace. And the reason for that is obvious, but there's a funny story behind it. When I told my company at Bizness Apps that we were getting acquired, the questions that I got ranged. I always like to joke, and it's true. I did like all hands in front of everybody, and then went into a conference room and said, "Hey, if you just want to talk one-on-one, I'm going to be in here." And I got questions from like, "Am I a billionaire, a millionaire, or like, when am I getting fired?" Everything in between, and it was so emotional. So when you do go through a process as well, you're bringing your team along for the ride as well. So my biggest fear was, telling my team we're, going to sell the business, it falls through. And then beyond that, I got a team lingering, thinking what's going to happen next? Like, are we done selling? Are we selling? Should I look for another job? That was my biggest fear. So I waited, pretty much until, we had a circled closing date. But yeah, so everything is completely private, and you get to vet the buyers. You can see their LinkedIn profile. You can see how much capital they have on hand. All the things that, I would personally recommend doing. If just a random person reached out, like look at their LinkedIn profile, look at, has anyone recommended them? Are they, a good person to work with? And then also, do they have, the funds to actually, acquire your business?
Yeah. That thing that you just mentioned, actually, I think is the number one issue with acquisitions that people don't think about, the morale aspect with your team. Especially if the deal doesn't go through, everyone is so distracted. It's really hard to come out of having gone through this process and going back to work.
It's tough. That's why, if you ever run a process and, you really get to the point where you have, let's say you have multiple letter of intents. And I tell this to, founders all the time. I say index on the ones that, have the best reputation, that, have the highest chance of closing, even if the price is a little lower, because, that extra 10% or whatever it may be in terms of price is not worth it in terms of risk. If you're working with an inexperienced buyer who, because in every acquisition, like there's something they find they don't like. With me, we had too many support tickets. Like literally we had so many support tickets, but we'd answer them within 2 minutes. And that literally almost caused, the acquisition to fail. There's tactics to, kind of mitigate that sort of stuff. But they're going to get cold feet, potentially. But I made sure to sell to a firm that when you sign the LOI, the deal closes, because that was my biggest fear. Because like you said, it does put your team through a roller coaster as well. maybe a less emotional one than you'll be on when you're going through due diligence and a lot of fun stuff.
If the team is part of the acquisition, as in, key component is let's say the acquirer wants to hire a bunch of your engineers, inevitably they'll want to interview them. How do you kind of ensure that people don't get wrapped up too much in the acquisition process in case it doesn't go through? But obviously some of these due diligence things do need to happen. They probably need to look through your books, which may mean you need to rope in your CFO or somebody. How do you handle that part?
Yeah, that's a great question. Depending on the acquisition and just, the buyer, I would just always, lead with just, honesty. Like, hey, this is a potential acquisition. I don't know if it's going to close, and they'd like to speak with certain members of the team. I'd also love to get your thoughts on them. Like, what questions do they have for you? I'd love to bring you into the process. I've always been a solo founder, so I've never had co-founders where, we need to sit at a table and kind of debate whether this is the right move. But if you have co-founders, like, that's a conversation where you want to clear that first. Absolutely. Because if you get far along with a buyer and then all of a sudden one of your co-founders says, I don't want to sell, and you're saying two different stories, the deal will blow up. No buyer wants to get involved with that. Or some do, but most would prefer, an acquisition where everyone's on the same page and excited. Because without that, excitement, if they're going to be joining the company, it's hard to see it working. It's like hiring someone who just doesn't want to work at your company. It doesn't make any sense. So in terms of, how to handle those conversations, just be honest. Just say, hey, we had someone reach out. We've been looking to potentially sell the business, and they're looking to interview, members of the team as part of the transaction. I'd love to get your opinion on them, and if you would even be, interested in working with them. Because if your team is part of the transaction and they're not willing to come along with a transaction, then that deal is already dead.
Mm-hmm.
So you need to also sell the deal to your team as well, not necessarily in a used carsman's way, but there's benefits to an acquisition. There's also benefits to staying private, not selling. But I would just say, keep it light, keep it honest, and involve their opinion in your decision-making process.
Yeah. That's another big one I've seen teams kind of fall apart on, especially since very often, at least for early stage acquisitions, the acqui-hire component is so important. If a co-founder doesn't want to go to a would-be acquirer, that's a dead deal, right? So potentially, and yeah, I think that's such an important point that people don't think about. Switching gears a bit, let's talk cash, stock, anything else. How do you think about, like, if somebody wants to sell their company, how should they think about what to kind of negotiate for? And I don't mean just value, but I mean, how do you know what are some of the considerations in taking the would-be acquirer stock versus cash, and on what timelines? Like, obviously everyone will have different preferences, but do you have ways to kind of think about how you make decisions in that?
Yeah, I mean, I think it depends on the acquirer to start, because if there's a stock component, you're going to want to do due diligence on that business too. Because if they're offering you, millions of dollars in stock, but their business is literally on fire when you enter it, you're going to quickly realize it's not worth anything. Or it's that 2 million in stock really is probably of lower value than, what it says on paper. So, I think it's completely appropriate, and I recommend, asking questions about, the financial position of the company if they're private. How much runway do you have? Interview other members of the team. It's a two-way street, especially if, there's going to be a stock component, or you're going to be joining the company through an acqui-hire. And that also gives you leverage as well. So you don't seem, like you said, desperate, which is very true. you don't want to seem like you're in a fire sale situation. Because if you're in a fire sale situation, you should just say it. Like, I'm just looking to sell a business. Whoever wants it, I'm just looking to pay back investors. I'm looking to get out of it. Whatever the reason is, that's sometimes that's not the best way to go, but sometimes that might be your only option. But if you've gotten ahead of it, where you've gotten to a point where you are able to negotiate stock, earn out, all those terms, cash, you definitely want to do due diligence on the buyer as well. Speak to members of their team, figure out what are they going to do with the product. It's safe to assume that you've spent some blood, sweat, and tears on the product, and are they just going to shut it down? What's their vision for it? Who's going to be working on it? Are additional resources going to be spent into it? I think those are the best acquisitions, when the business is bought, and then maybe you could only take it so far, and then when it's acquired by a larger company, you're able to see what you built, reach more people and help more people, however it does that. But yeah, due diligencing the buyer is kind of the short answer.
Is it appropriate to ask for their financial statements, their cap table, their?
Absolutely. Yeah. I would recommend that. I mean, if they hold it back, why? That's the question I would have. Why? And that's where you start to feel that sort of goodwill and tension. If it's a good, by this point, I'm assuming the CEO is involved, the CFO is involved. You're probably gonna have separate calls with each of them. Microacquire was actually almost acquired multiple times before we raised capital. And I would speak to the CEO, the CFO, and we didn't go down that path. But in one scenario, it was heavily weighted on stock, and I asked for full financials of the business. And they were going through an upcoming fundraise. I talked to the CFO. I talked to probably 10 members of the team. I went to lunch with the CFO. I went to lunch with, the head of, I can't remember his role. He's no longer at the company either as a CFO. So I made a good decision. Those questions are important. Like, I'm going to come work for this business, and, I'd like to know that it's are you transparent? Do you tell your team, certain things, or is this all hidden behind a closed wall and I just have to take your word for it? To me, I wouldn't be comfortable with that.
Yeah. And so one thing I want to touch on in this market, and I'm actually seeing this a fair bit with some of our portfolio companies, some of the later stage startups out there, their last rounds were raised at ridiculous valuations, a year or 2 years ago, and they're doing stock buys now at those prices. And so my question actually to you is, how do you think about what what price is fair? Because it almost seems like many of these companies who are doing stock deals are getting a steal, but it looks good because it looks good, but it looks good because their stock may be inflated, but who knows whether something is inflated or not, right? That's all subjective. How do you think about that in this market?
Yeah, I actually have joked in my team. I was like, man, we should have went after that $1 billion valuation so we could just roll up a bunch of companies with our stock.
Yeah.
Companies are doing it, and almost in a predatory manner, like, hey, here's 20 million of my stock overvalued by 90%. So I'd be very conscious of that. And that's where you really want to do due diligence on the buyer in terms of, can they grow into that valuation? Are they issuing this amount of stock kind of knowing that there's a very high likelihood that valuation that they took in 2021 they won't ever be able to grow into? But yeah, that's something that I've seen a few companies do, and I've seen it work out great, and then I've seen it work out not so great. So it just depends on the company. You know, there's a lot of great companies that raise at high valuations, and that's fine. I think it just depends on what the company is, how you get along with them, and if you believe in their mission. You know, I think you know what we're going through right now, just kind of on a macro level. You care if I just throw my like opinion?
Yeah, go for it.
Yeah, like if you're long on startups and tech and stuff like that, you know, things definitely got, you know, really out of control for a bit, but that's just how, you know, market cycles work, where things go up and things go down, and the faster they go up, the faster they go down. So I wouldn't be thinking so much in the short term, like, okay, today this stock is worth this. Like I'd be thinking more of, okay, assuming I have a 4-year vesting schedule, where could this company be in 10 years? Do I believe in the mission? Like, do I believe in, you know, the vision? Do I believe in, you know, the CEO and the founders of the business? You know, I think those are really, really important factors. And if you do, then it could be a great outcome for you and your investors if you have them.
Mm-hmm. Are there any sort of considerations in this question of cash versus stock, like tax considerations, QSBS? Is there anything that you kind of think about regarding any of this stuff? I'm not even sure the exact question to ask you.
Yeah. So full disclosure at Acquire, we can't do stock purchases. So we don't see too many of them. And the reason for that is you're trading securities. So your co-founders need to be SEC and FINRA. So we're registered as a brokerage firm. So we only do asset deals. But my first acquisition was I negotiated a stock purchase agreement because you're taxed differently. So when you do an asset sale, you're typically taxed at ordinary income, and then on a stock purchase, you're taxed at long-term capital gains. And then I also benefited from QSBS, which is, I think it's going away now. I need to like.
No, it's still around. Still around.
I heard it's like changed, or it's like 13% now or something like that.
Yeah, it's not entirely free anymore, or whatever you want to call it, but yeah.
Yeah. So for those that aren't familiar with QSBS, it's qualified small business stock. And essentially, if you hold stock in your company for 5 years or more, and there's some other items around it to qualify, like you can't have a certain amount of working capital in the business over time. What else? Just talk to your accountant. But yeah, so if you can, that's a big bargaining chip, is if you're able to negotiate, you know, stock purchase against an asset, you know, purchase, you know, that could have a material difference on, you know, your tax take home. And just one very, you know, simple example would be, let's say, let's just assume you own 100% of the business, and you're going to sell it for $10 million, and you do an asset sale where you're going to be, you know, probably paying, you know, 3-4 million in taxes. If you do a stock sale and you benefit from QSBS, then you're going to just be paying whatever your state tax is, and then 13% federal. It used to be 0, but now I guess it's 13. So that could sway your take home from, I'm doing like fast math right now, and I'm probably getting it wrong, but it's a difference between like 6 and like 8 million. So it can be a very, very material, you know, difference in your outcome.
Yeah. I didn't realize that retrading stock, as in exchanging your stock for somebody else's, allows you to continue on that QSBS journey. I don't know the legal ins and outs.
Oh, I wasn't referring to that. I mean, well, a stock purchase would be a stock purchase. So I assume, yeah, ask your accountant.
Okay, well, I guess the long and the short of it is there are many considerations in deciding an all cash or cash and stock or all stock deal, and certainly tax or whatever may be one of them that you may want to talk with your lawyer or your accountant about. Okay, in the last few minutes here, I guess let's spend a moment on the buy side in terms of, you know, do you have to have capital to buy a company, or can you get that financed?
Yeah, you do. You name
Or-
a- yeah. Like one really common way to acquire companies is with something called seller financing. So essentially what you're doing is you're creating almost like a promissory note with the owner of the business, where like an example would be maybe you're buying the business for 2, 3, 4, $5 million, and half of it's cash, half of it's seller financing. It's not half cash, half stock. And seller financing just basically means, over the course of 24 months, 36 months, 12 months. Typically, seller financing is between 12 and 24 months, but basically means the buyer is going to pay you a monthly payment, typically using proceeds of the revenue of the business to pay you. So that's a creative, structure. Then there's, other ways to, lower your cash due on closing with things like conditional holdbacks, which is basically, hey, we're going to hold back 20% of the purchase price for a year in case a co-founder pops out of nowhere, a lawsuit pops up or something like that. Or we need you to document all the code or something like that. So you get that done. There could be a number of different reasons there, but yeah, I mean, I do hear a lot of like, on Twitter from here, like you can buy a business with no cash down and stuff. Is that kind of what you're referring to?
Yeah, like with an SBA loan or something like that.
Yeah, you're still going to need some form of personal capital. But I have heard of situations where there's 100% seller financing. But I haven't seen it. And then, yeah, there's resources like small business loans where you can acquire businesses pretty sizable. But they do come with a personal guarantee. So you're kind of putting your whole net worth at risk, if you will. But yeah, SBA loans are a great way to potentially, acquire a business, pay that down, and then at the end of it, it's basically like buying. It's like a mortgage for a business. And then there's also third-party lenders as well that we work with. But creative financing with the seller combined with financing from banks or some of the newer parties coming into the market can be a great way to put, let's call it 20% down, and the rest is financed by either the seller or a loan.
Great. Well, thank you so much, Andrew, for joining us. If people are interested in, learning more about how they might be able to get their business acquired, where should they go on your website? Just go to the site itself or somewhere else?
Yeah, go to acquire.com, click one of the big buttons that say join now, sign up. If my CTAs aren't big enough, let me know, we'll make them bigger. And we'd be happy to help.
Great. Well, thank you, Andrew. This has been really informative for me and hopefully for everyone else. Thank you all for joining.
Yeah, thanks for having me, and hope this is helpful.
Thank you. All right, take care.